What if the next market crash doesn't start with panic, but with confidence? What if the early signs look calm, optimistic, even exciting, just like they did before the 2008 stock market crash? Most investors believe crashes come out of nowhere. But the truth is, the warning signs are often visible long before the headlines turn negative. And understanding the real lessons from the 2008 financial crisis could quietly change how you invest starting today. If you care about protecting your money and thinking long term, make sure you like this video and subscribe to US Finance Insights, because here we break down complex financial history into simple, practical insights you can actually use. Now picture the atmosphere in 2006 and 2007. Home prices were rising fast. Banks were approving loans easily. Financial news felt optimistic. Many Americans believed housing was the safest investment possible. People refinanced homes, took on larger mortgages, and assumed values would continue climbing. It didn't feel risky at the time. It felt smart. And that's exactly where the first warning hides, when risk feels invisible. The lessons from the 2008 financial crisis really begin with overconfidence. Investors, banks, and even everyday families believed the system was stable. Mortgage-backed securities were rated highly. Credit was flowing freely. But underneath that surface stability, debt levels were growing rapidly. Adjustable rate mortgages were ticking time bombs. When interest rates adjusted and housing prices slowed down, cracks began spreading across the financial system. And here's something many people forget. The 2008 stock market crash wasn't just about numbers on a screen, it was about real fear. Retirement accounts dropped sharply, businesses cut jobs, families faced foreclosure. The emotional shock was just as powerful as the financial damage. When markets fall quickly, logic often disappears and fear takes over decision-making. But if we rewind even further back to the late 1990s, we see a similar emotional pattern during the dot-com bubble crash. Internet companies were exploding in popularity. Investors believed technology would reshape the world overnight, and in many ways it did. But stock prices detached from reality. Companies with little revenue were valued at billions of dollars. Everyone wanted in, no one wanted to miss out. That fear of missing out is dangerous. It pushes investors to ignore fundamentals. During the dot-com bubble crash, the Nasdaq eventually lost nearly 80% of its value from peak to bottom. Years of gains disappeared. People who invested based purely on hype suffered the most. And this is where history quietly rhymes. Innovation is real, growth is real, but valuation always matters. One of the most powerful lessons from the 2008 financial crisis is that asset bubbles often build slowly, then burst quickly. At first, price increases feel justified. Then they feel exciting. Eventually, they feel unstoppable. But when momentum shifts, it shifts fast. The same psychology that drives prices up can drive them down even faster. Now, let's pause for a second and connect this to today. Think about modern market trends, artificial intelligence companies, fast-growing tech stocks, new investment themes. They attract massive attention. That doesn't mean they're bubbles, but it does mean investors must separate excitement from analysis. One of the biggest stock market lessons from past crashes is simple. Don't invest just because everyone else is. Another critical lesson is diversification. In 2008, many investors were heavily exposed to housing-related assets. When housing collapsed, their portfolios collapsed with it. During the dot-com bubble crash, investors concentrated in tech stocks faced devastating losses. Diversification doesn't guarantee profits, but it reduces the risk of catastrophic damage when one sector falls apart. And here's where discipline becomes more important than intelligence. The investors who survived the 2008 stock market crash weren't necessarily predicting the recovery. They simply avoided panic selling at the bottom. When markets fall 30 or 40%, it feels unbearable. But historically, markets have recovered over time. Emotional control often determines long-term success more than perfect timing. Another overlooked lesson from the 2008 financial crisis is the danger of excessive debt. Leverage magnifies gains in good times, but it multiplies losses in bad times. Banks were over-leveraged. Homeowners were stretched thin. When asset prices dropped, debt obligations remained. For today's investors, maintaining manageable debt levels is one of the smartest defensive strategies available. Let's also talk about liquidity. During financial stress, cash becomes powerful. Investors with emergency funds in 2008 had flexibility. They didn't have to sell investments at the worst possible moment just to cover bills. Financial stability isn't just about maximizing returns. It's about building resilience. And here's something most people don't realize. The lessons from the 2008 financial crisis are less about predicting the next crash and more about preparing for uncertainty. No one consistently times the market perfectly, but investors can prepare mentally and financially for volatility. That preparation includes diversified portfolios, realistic expectations, and a long-term strategy. During both the dot-com bubble crash and the 2008 stock market crash, media headlines amplified fear. Every day brought new negative stories. It felt endless. But market cycles are normal. Corrections are part of economic systems. Even severe recessions eventually end. Investors who understood financial crisis history were better equipped to stay patient. Now here's a practical framework you can apply immediately. First, regularly review your portfolio allocation. Make sure you're not overly dependent on one sector or one trend. Second, evaluate your risk tolerance honestly. Could you handle a temporary 30% decline without making emotional decisions? Third, maintain liquidity so you're not forced into bad choices during downturns. Another lesson involves expectations. Bull markets can create unrealistic return assumptions. When investors expect double-digit gains every year, even normal corrections feel catastrophic. Adjusting expectations help reduce panic. Long-term investing is rarely a straight upward line. It's a series of cycles. It's also important to distinguish between innovation and speculation. The internet transformed the world, but many dot-com companies failed. Housing remains important, but speculative lending caused instability. Today's technologies and industries may be revolutionary, but not every company will survive competition and economic shifts. This video is for educational purposes and reflects general market behavior patterns, not financial advice. As we move toward the conclusion, let's clearly summarize the core lessons from the 2008 financial crisis and the dot-com bubble crash. First, avoid overconcentration in one hot sector. Second, keep debt at manageable levels. Third, control emotional reactions during volatility. Fourth, prepare for downturns before they happen. And fifth, remember that long-term investing rewards patience more often than panic. Ask yourself this honestly. If markets dropped sharply tomorrow, would your financial plan hold up? Or would stress force you into quick decisions? Preparing now is easier than reacting later. That's the difference between informed investing and emotional investing. History doesn't repeat in exactly the same way, but patterns of human behavior repeat constantly. Greed during rapid growth, fear during sudden decline, relief during recovery. The investors who understand these cycles position themselves differently. They don't chase every rally, and they don't abandon strategy during every correction. I'd love to hear your thoughts. What do you think is the biggest lesson from the 2008 crash that investors still ignore today? Do you see similarities between past bubbles and current market trends? Or do you believe this time truly is different? Share your perspective in the comments below because thoughtful discussion helps everyone grow. If you found value in this deep dive into the lessons from the 2008 financial crisis, consider sharing this video with someone who's investing for retirement or building long-term wealth. Sometimes, understanding past market history can prevent future financial mistakes. And if you want clear, steady, and practical insights about the U.S. economy and investing, subscribe to U.S. Finance Insights. We focus on helping you stay informed, think long-term, and build financial confidence without hype or fear. The market will always move in cycles, but informed investors move with awareness, not emotion.